to today's video, which is of course being recorded some 2 hours before the opening bell Monday, and its title is S&P 500, how far are we in the bottom formation, volatility examination, options market positioning. We'll dive into cryptos as well, and of course the perspective on the US dollar as seen from various currency pairs perspective. So this is going to be pretty packed, and I will be hurrying to deliver it to you as fast as possible. Thank you for liking these videos. Thank you for liking and subscribing to the channel. Let's dive right into the key chart published in Saturday's extensive video. You can see two levels drawn in S&P 500 futures, and you remember my tone mentioned regarding the volatile process of bottoming and my distrust of Friday's bounces being the definitive ones, being more than oversold bounces. And I cautioned you to the possibility of us for a while meandering between the lower turquoise line and Friday's intraday lows, which is exactly what we are seeing today pre-market, and we'll examine the clues where I see the market going after the opening bell today and in the days ahead. One reminder of the crypto bearish call made on the weekend, and you can see that no strategic reserve announcement or basically publicity given to this long-term well-known intention has been able to move Bitcoin sustainably higher. So I was still, and I am still, bearish cryptos. But why I'm showing you this tweet is the not so apparent necessity of there being a panicky flash, a moment of blood in the streets, which is what we could be buying with both hands in S&P 500 and the Nasdaq. This is quite and could be quite analogical to the October 2022 situation where we got a bounce of very oversold conditions. Everyone was waiting for another shoe to drop. It did not, and of a prolonged weeks-long consolidation, equities started to drift higher. That was the time of Credit Suisse worries and everything else. This is the crypto chart featured in the prior tweet, where you can see the pre-market from the US perspective being sold into, and of course the long Sunday declining candle called in Saturday's presentation for you, just like I did the week before, right before the dip, right before the rip, and the 2 weeks ago video covering upcoming breakdown from the sideways consolidation. And as you can see, bottom is nowhere near to be found, and MicroStrategy, Strategy, Coin, other names, Mara, Riot, they will feel it. This is that chart in detail, and let's now go into S&P 500, which is the pre-market situation today, and it's right in the drifting lower still, rips being tentatively sold, and examining the upcoming volatility perspectives would make it a clear direction to be still ruling through today. But for now, for our perspective, you can see that the MACD histogram is slightly deteriorating again, and bullish initiative simply did not come. And why should it? With China inflation data in some 24 hours ago and still struggling with deflationary readings, dipping into them right again, which is not a good omen. Volatility perspective, Friday's closing prices. One can argue, as I did in Saturday's video, that there is an upside rejection, but is it a definitive one? No, not at all. And in the video I mentioned that there would be a period of still back and fill within the context of Friday's long candle, including its upper knot. So we have still a lot to look forward for, but again in the context of a deep flush, panicky flush, far from being guaranteed, because what has been the key word of the well-received and super extensive yen carry trade unwind presentation, one more week to the past, orderly, everything is pretty orderly, and you can see it either in VIX, you can see it in S&P 500 decline, you can see it in Nasdaq decline, and of course as well in US dollar and Japanese yen, where it's only the euro that is running wild on all the deficit financing, together with DAX and select other local European equity markets. VIX to short-term VIX, VIX to forward-looking VIX, however you call it, this is as well apt to do some backing and filling, but again due to the orderly nature, as I was telling you 2 to 3 weeks ago, it's not going to be panicky, spiky, flashy at all. I reassured you on the following weekends that the market posture and my opinion have not changed, and this is still the message for today. VIX on Friday close, hourly perspective, you can see that the higher high had been rejected. However, this is all in the context of backing and filling, because this is how it looks right now pre-market. Another push higher in the context of making a higher low, which means that the pressure is building, but there would not be a disorderly release guaranteed. It's not guaranteed. We might get one or we might not, and it would be a case of mismanagement of a very unopportune moment if we got a panicky moment. I do not think we are going to experience that one, because even the government shutdown situation is not guaranteeing one per se on account of this moment at all. Another perspective, do you see any kind of panic building here in the puts to call ratio? No. For all the fear readings, we are not in extreme fear, and we are not going to be seeing one extreme fear reading guaranteed. One thing is cryptos, another thing is equities, and completely another thing is bond market posture. And bonds are most measured and have been historically always showing the greatest countenance. So take those panicky, clickbaitish headlines you run into in the media with more than a pinch of salt. US dollar. I would argue that we had seen a lion's share of the flush already, and we are in for a reprieve. I'm on the record as saying that this is not going to be in one straight line down to 100 to 101 support. Not really. We might see 105, 105, 50, or maybe even 106, which would correspond to February lows. Roughly, it is still possible, but I am looking for a micro rebound in the US dollar, because remember that almost 2/3 of this USDX, which is what is being charted here, is the euro, and this is the euro chart, 4-hour chart. And ever since market saw Germany abandoning fiscal discipline and almost joining the club Med the way France did after the PIGS crisis, which is clearly seen in the debt to GDP ratio down there, where you can see that basically the countries that had made greatest progress on debt consolidation had been those in the focus of the 2011 crisis. So now the North and South have a little bit caught up to each other in respects that will come back to bite Europe 1 or 2 years down the road. Maybe even more. Depends on how they progress with the deficit spending, rearmament initiatives, and ratcheting up tensions in other non-economic areas strictly. Enough said. So that's so much for the euro, but what I would caution you here is waning momentum behind the euro appreciation, meaning this chart also confirms that the euro is in for a short-term respite, and it would coincide with the US dollar appreciation in this move to anything between 105 and 106. And once again we go back to the word orderly. Even if you look at Japanese government bond yields, it would be premature and inaccurate to draw up a parabola there. It's steeply rising, yes, but it's an orderly pace of Japanese government bonds monetary policy normalization, and the same is seen in euros, in the US dollar to Japanese yen currency exchange rate. Do you see any kind of an acceleration here? It would be very positive for the US dollar and for equities to see a bit more US dollar strength in this area as well. But the reflexive rebound not the reflexive rebound, or wrong choice of words, proper description would be retracement higher of part of the prior decline. It would be very good for risk taking if it came from the US dollar to Japanese yen, which is the second most important pair. And if you see coming back to euro, the move starting to get mirrored in as well US dollar to Swiss francs, it's getting serious across the old continent. So my joint page will help you select what's right for you based on what and how you trade. I've already charted somehow the perspectives as they stand for equity indices. This morning the buyers will have to prove their mettle, but for now it's another pre-market high is being in, and it will take a lot of effort to overcome it, given what I have told you about the forex arena and thus far non-existent US dollar push higher. We would need yields to rise for that. I had been covering at great length why the index of economic surprises is deteriorating as of not the preceding but the one before Friday, when it became clearly apparent that those stagflationary wave of data are prevailing, and that is what had been sending the US dollar lower. So we are waiting for a retracement in the dollar to show up. So having said that, I will rush in to upload the presentation as soon as possible after doing a thorough sound cleansing. Obligatory disclaimer, and let's talk soon again. Thank you.